Kind of walk us through the deal, the money getting raised. What are the time frames? What are the big milestones in this process?
All right, so the first step is a sponsor putting up the capital to pay for the IPO. So let's use DraftKings, for example. So they raised the SPAC was a firm, we'll just call them Diamond, it was the name of the SPAC. And almost all SPACs have the names Acquisition Corp at the end. All right, so I believe it was Diamond Merger Acquisition Corp. And they raised $400 million. To raise that $400 million, it cost them, remember I said $5 million per 100 million, so 5 times 4, approximately $20 million. So they wrote a check for $20 million, most of which went to a bank, investment banker who was the underwriter, and some went to lawyers. And then they had some other costs to pay for the transaction itself. But none of that capital goes to them. They can't charge fees. They can't take any of that capital back. 100% of the $400 million that was raised goes into a trust account, which is managed by a third party. So however long it takes you to put the $20 million together is however long it takes. For some people, it takes months or weeks. For some people, it's 1 day or 5 minutes. You write the check, right? So however long that takes, that can be very quick or that can take a long time. The roadshow itself doesn't have to take that long. You do meet with investors. The majority of investors in SPACs today are hedge funds. And that's because hedge funds it's a financial instrument. There's no valuation of a company or multiple of EBITDA or multiple of revenues, just what type of warrant coverage am I getting? How long am I gonna have my money out there? Who's the third party trust manager? So it's very basic questions that the hedge funds are asking. And they do wanna know about the management team and the strategy, but they're really concerned about the fundamentals of the financial investment. So you go on a roadshow to raise the $400 million, and their roadshow probably took about a few weeks. It took a few weeks, investors in New York, Boston, Canada, et cetera. There are a lot of SPAC investors in Canada, interestingly. And then you raise the $400 million primarily from institutional investors. Now you're a publicly traded company, and you have 3 securities. In their case, they had 3 securities. One was the units, the second were the shares, and the third were the warrants. And they trade freely and separately on the exchanges. NASDAQ has been a very big exchange, or firm. We have a relationship with the New York Stock Exchange, which has now become the #1 exchange for bringing SPACs to the market. And so we were able to, in that situation, the company raises the $400 million, and the $400 million is put into a trust account managed by a third-party entity, a trust company. And the management team has no access to that capital. That capital is invested in treasuries, as I mentioned. And the sponsor team now has 2 years to go and find a company. In the case of Diamond Acquisition Corp, after around a year, they identified a company, DraftKings, and another company called SPAC Technologies. They negotiated with them. That probably took about 2 months. They announced the transaction, which was the DraftKings deal, in around December of 2019. It took them a few months to close the transaction. They raised a PIPE in between, that private investment in public entities, where they went to a select number of institutional investors to get capital, and they closed the transaction in August of this year. April of 2020. So the whole process takes less than 2 years, and the value today of the sponsor capital is several $1 billion, actually. So they invested 20 million and they've made several billion. And now it's a publicly traded company, and you can buy shares in DraftKings, and they're no longer a SPAC. So they have de-SPAC'd. They're now a regular way public company. So that's an example of the whole process, beginning to end.
For more episodes, visit thedealflowshow.com and subscribe.